The US dollar, the backbone of global finance for over 75 years, is showing signs of strain that we haven't seen in decades. Now, I know what you're thinking. The dollar has survived recessions, crises, and wars. How could it die? But here's the thing. It's not just about surviving, it's about dominance, and dominance is slipping. Right now, the USD still represents roughly 60% of global foreign exchange reserves, but the cracks are forming. And if we pay attention, the picture is clear. The world is gradually reducing its dependence on the dollar, and it's happening faster than most people realize. Let's break this down. First, a quick history. Since 1944, when the Bretton Woods Agreement cemented the USD as the world's reserve currency, it has been the backbone of global trade. Oil, commodities, international loans, everything was priced in dollars, which made it almost impossible for the world to function without it. The United States had a unique combination of economic might, technological advancement, and military power that reinforced the dollar's supremacy. It became the apex predator of currencies, and for decades, this dominance was unchallenged. But history is littered with examples of powerful currencies that eventually fell. Take the British pound. It ruled global trade for more than a century before slowly ceding ground to the dollar in the 20th century. The story of currency dominance is cyclical, and while the USD is strong today, there are multiple factors now putting pressure on it. First, let's talk about U.S. debt. As of late 2025, the United States national debt sits around $36 trillion. To put that in perspective, that's more than 120% of GDP, and the interest alone costs the government over $900 billion annually. That's nearly $1 trillion going out of the Treasury just to service debt, not to fund infrastructure, healthcare, or defense, just interest payments. And the problem isn't only the amount, it's the speed at which it's growing. The Congressional Budget Office has projected that by 2035, debt could exceed 150% of GDP if current trends continue. Each year, the world watches the U.S. issue more debt, and foreign investors slowly start questioning the dollar's long-term stability.
Then there's inflation. The U.S. has been through a turbulent few years. After the 2020-2022 pandemic-driven economic stimulus, inflation surged to 9.1% in June 2022, the highest in over 40 years. While the Federal Reserve has aggressively raised interest rates since then, peaking at around 5.5% in early 2024, inflationary pressures are still a concern. When inflation erodes purchasing power, it undermines confidence in the dollar, and confidence is everything for a currency's dominance. And it's not just domestic factors. Globally, the dollar faces competition like never before. China, for instance, has been pushing its digital yuan and encouraging trade in yuan instead of USD. Russia has moved a significant portion of its reserves away from dollars after sanctions in 2022. And even countries like Saudi Arabia and the UAE have signaled interest in alternative settlement currencies for oil trades. Central banks around the world are slowly diversifying. In fact, as of Q3 2025, the share of global reserves held in US dollars has slipped to about 58%, down from 71% just 15 years ago. That may not seem like a huge drop, but in the world of finance, a few percentage points represent hundreds of billions of dollars leaving dollar assets. Now let's look at the US dollar index, DXY, which measures the USD against a basket of other major currencies. Over the past decade, the DXY has fluctuated between 90 and 103, but since 2022, we've seen increased volatility. Each time the dollar weakens, it raises concerns about the U.S.'s ability to maintain its purchasing power globally. And when foreign governments and investors start hedging against the USD, it creates a feedback loop that accelerates the erosion of dominance. At this point, you might be wondering, so is the dollar going to die tomorrow? Well, let's be realistic. Currencies don't just collapse overnight. There's almost always a slow erosion, a gradual shift in global confidence, and periods where alternatives gain traction. For example, consider the rise of Bitcoin and other digital assets. While digital assets are still a tiny fraction of global money, they represent a new paradigm. People can transact without relying on traditional banking systems or reserve currencies. Central banks are watching this closely, and CBDCs, central bank digital currencies, are coming faster than many predicted. If the world adopts digital currencies for settlements, it could reduce the dollar's hegemony dramatically over the next 10 to 20 years. Now here's something important. Geopolitical tension matters. The US dollar's dominance has historically depended on trust in US institutions. But when countries like China, Russia, and India push for trade in local currencies, it signals a shift. In 2024, China and Russia finalized agreements to settle over $200 billion in trade outside of the USD, bypassing the dollar entirely. That may seem small on the global scale, but it's a warning shot, a demonstration that countries can, in fact, function without it. But it's not all doom and gloom. The dollar still has incredible advantages. The U.S. remains the largest economy in the world with a GDP of over $27 trillion in 2025. And the U.S. Treasury market is still the deepest and most liquid in the world. Global businesses, governments, and investors continue to rely on dollars because there's simply no better alternative for large-scale transactions. And this is where we have to separate erosion from death. The dollar may lose some dominance, but for now, it's still the safest global currency. Now, if you're following closely, you might see why this is a critical moment. If we think the dollar is unshakable, we could be caught off guard by gradual erosion. And this is where your actions as investors and individuals matter. Diversification, holding assets in multiple currencies, gold, or even cryptocurrencies, can protect you if confidence in the USD starts to waver further. By the way, if you're following along and thinking this analysis is eye-opening, go ahead and hit that like button. It really helps us know that we're giving you the kind of insights that matter in today's financial world. And don't forget to comment below if you're considering shifting any of your portfolio away from the dollar. We'd love to hear your thoughts. Let's look ahead. In the next 5 to 10 years, several key factors will determine the USD's fate. Federal Reserve policy. Will they manage inflation without triggering a recession? U.S. debt ceiling and fiscal discipline. Will Congress implement measures to control runaway spending? Global reserve currency diversification. Will central banks continue to diversify into euros, yuan, or digital currencies? Geopolitical events, sanctions, trade wars, and alliances can shift trust away from the USD. Now here's a scenario that might shock you. If the U.S. continues to run $1 to $1.5 trillion annual deficits, and if foreign investors start demanding higher yields to hold Treasury bonds, interest payments could balloon to over $1.5 trillion by 2030, which would severely limit the U.S.'s ability to fund other programs. If confidence erodes further, we could see a significant drop in the USD's global purchasing power, maybe 20 to 30% over a decade. That would be huge for importers, exporters, and anyone holding cash-heavy portfolios. But again, let's put this in perspective. Even a 30% decline would not be a total collapse. The dollar is deeply embedded in global trade, contracts, and reserves. Death is dramatic. Erosion is gradual. And right now, the world is still very dependent on the U.S. economy, its institutions, and its financial infrastructure. So, what should we do? As investors, we watch 3 things closely: U.S. debt trajectory, Federal Reserve policies, and global currency trends. We also look at digital currency adoption, because that could accelerate the shift away from fiat dominance faster than we anticipate. Countries like China are aggressively building digital infrastructure for their yuan, and Europe is exploring a digital euro. These aren't small moves. They are systemic changes that could reshape global finance over the next 10 to 15 years. Here's the bottom line. The US dollar isn't about to vanish overnight, but its supremacy is being challenged like never before. We're seeing a perfect storm of debt, inflation, global diversification, and digital alternatives. If history teaches us anything, it's that no currency reigns forever. The British pound fell, the French franc fell, Even the Japanese yen has seen moments of vulnerability. But the USD is still strong because for now, we trust it, we use it, and the world is built around it. Still, being proactive matters. If you're holding most of your wealth in USD, consider diversifying into foreign assets, commodities like gold, and emerging digital currencies. Monitor the DXY index, Treasury yields, and central bank policies regularly. And always remember, the dollar story is not just about money. It's about trust, confidence, and global influence. Finally, as we look to the future, here's the key takeaway. The US dollar may face a slow decline, and global reliance on it may weaken, but it's not dead yet. What's more likely is a gradual redistribution of global currency influence, where the dollar remains a cornerstone, but shares dominance with emerging currencies and digital assets. We need to stay alert, stay informed, and adjust our strategies accordingly.